Let's do disability income. How many of you can live for 30, 60, 90 days without a paycheck? How many of you can live 30, 60, or 90 days without a paycheck? Anybody? Is my microphone on? Nobody? Wow. So if you got this, not a chance. Ah! Nope, not in this economy. No, there's no way in this economy. You're right. All right, so disability income. My question is, through my entire career, I never had competition for long-term care or disability. As a matter of fact, you people brought it to me to say, hey, this guy wants a DI policy. You want to write it and split it? And I would do that. I never understood that. It's 20 times more likely that you'll be disabled than die. Have you ever not known somebody in your life that had a broken arm or a leg or had some kind of little disability? It's weird, isn't it? So disability income, when you think about it, can be very detrimental. You'll learn shortly that long-term care, I'm sorry, disability income in LTD policies at companies, they only pay you 60% of your income. We did financial planning for our clients, which meant I went through an extensive cash flow program with them. And I would ask them, how much is your mortgage payment? So after the federal government, the state, and everybody else robbed you of your 30%, your net income that was left, 50% of it went to what category? Mortgages. Right there. And I would show that to people. And then I'd show them only 60% of your income is coming from your work if you get disabled. And they just go, oh. So credit life, credit disability, disability income from work will help balance that out and preserve and protect your family and your assets. So what is disability income? It's loss of time and loss of income. Highlight time and income. It can either pay a flat benefit like $5,000, write down $5,000, or a percentage, which is what most of them do. Highlight percentage. Percentage of earnings. Benefits are paid monthly. Circle, circle, star, star. Not designed to replace your full income. Not designed to replace your full income. All right? So if your flat benefit is 5 grand, or it's a percentage like 60%, instead of 5 grand, you're only going to get 3. Just enough maybe to cover the mortgage. Pure loss income is income replacement, provides benefits highlight without the need to be totally disabled as income goes down. So maybe you have something happen to you and you need your income replaced, but you're not able to go back to work for full benefit. That's what we call residual income. We'll learn that in just a moment. We'll help offset that loss of income to keep you excited and going back. So, what are characteristics of a disability income policy? There it is again. The time limitation. Time elimination. It's the time deductible. Remember that? So characteristics of a disability and put LTC plus disability, they both work the same way. Use the elimination period, the time, write down time deductible. Write down LTC for long-term care plus disability. Both use the elimination period and the benefit period. So the time deductible is what you wrote here. The time period after the onset of the benefits are paid. So write down 30, 60, 90, and 180 days. 30, 60, 90, and 180 days. Remember, if you chose 90, you get no benefits for 30. You get no benefits for 60. You get no benefits for 90. Your benefits begin in the 4th month and paid in the 5th. The time deductible. Now, the benefit period is the amount of time benefits are payable. Highlight benefits payable for disability. It could be 1, 2, 5, 10 years, or up to age 65 or 70, whichever your company provides you for. Can I repeat which part? The elimination clause or the whole thing? Okay. All right. Did you write LTC up here plus DI? LTC? Long-term care? Okay. And then did you write time deductible here? Because the elimination period is your time deductible. You are now? All right. Did you write time deductible here? Okay, thank you. That's the time period before the benefits are paid. So if you wrote down 30, 60, 90 days, that means your time deductible, your elimination period is how long? 90 days. You're not going to get paid for 30, 60, or 90 days. You don't get benefits paid until the beginning of the fourth month, and you get your paycheck on the fifth. Does that make sense to you? Please don't be writing while I'm talking. This is for 90 days, correct. So my example is 90 days. You're not going to get any money for 30, not for 60, not for 90. Your benefits begin after the elimination period. So your benefits begin in the fourth month, and you get paid at the end of the fourth month in the fifth month. Got it? You think so? Did you write down 30, 60, 90 days? Yes, no? Please help answer me faster. Yes, I get that you're getting paid after 90-day period. Okay. So, so you get earnings starting in the fourth month and you get paid in the fifth. Do you understand that part? This is the hard part with doing it things like this way. I'm hoping I'm answering your questions. All right. So you know you're not getting paid for 90 days. Yes? We're just going to break it down real simply for you. Okay. So after 90 days, that's when your benefits begin to accrue. So in the fourth month, your benefits begin to accrue. You're not getting paid, your benefits are accruing for you. We got that? Got it. Okay. So after the fourth month, you've accrued 1 month's benefits. In the fifth month, you'll get 1 month's pay. Got that? Yay! That's the deal. And then you got the benefit period. That's the time period we pay you from that point forward for 1 year, 2 years, 10 years, or up to 65 and 70. Are we cool? So much easier back in the day when I had a board and I could write it out for you. All right, congratulations. You're welcome. All right. Now, it's really important that y'all know this because it applies to both disability and long-term care. We're going to learn this again in long-term care. So, which of the following terms best describes how long I'm stuck paying you? There you go. Mhm. How long am I stuck paying you? Oh my gosh. Perfect. All right. It's not C. It's not the disability period. Here I'm talking about how long am I, the insurance company, stuck paying you income benefits? Which one describes that? So it's not the disability period. It's not the coverage period. This is asking you how long is the insurance company stuck paying you money, income, benefits? There you go. Do you understand now? You feel better? We looked right over the key term. That's why we're here. Practice, practice, practice. You got it. And keep the humor. We all agree it's B, the benefit, period. Income benefits. All right, B is it. Qualifying for benefits include occupation versus non-occupation. Now, occupational is a policy that covers you on and off the job. Disability income covering you on and off the job is called occupational, so highlight on and off. Now, most policies are non-occupational. See, most companies have what, write this down, have workman's comp. They have workman's comp. Workman's comp covers you right down on job. So if you're at work and you get hurt at work, your workman's comp covers you on the job. It's that simple. So if you have workman's comp, you would need non-occupational. Non-occupational because that covers you right down off job. Highlight off job. Non-occupational is off the job. Workman's comp is on the job. Okay? So the definition of disability. How do we define what a disability is? It's either own occupation or any occupation. Let's look at the differences. Own occupation provides benefits if the insured is highlight unable to perform all your main duties of your own occupation. So the story here is I had a customer or a client. He came in, he was a doctor, a surgeon, and he wanted disability insurance. So I got him $10,000 a month, cost of living, and I showed him to pay for it without a pocket, after tax expenses, so he would get the full benefit. He was okay, and he did it. After a year or so, he came back and he says, I got to file disability. I looked at him, I said, why? And he said, because I have a twitch. In his hand, you couldn't even notice it hardly, except very rarely over a long period of time, his hand would begin to twitch. Could you imagine him operating on you, providing surgery, and then having a twitch? Yeah. Yikes. So they kicked him out of his job. So I got him covered. He receives $10,000 a month. He was young, so he's got this for all his life. He got $10,000 a month, cost of living, waiver of premium. He got all that money. A couple years later, we're having coffee, and he says, I'm bored. What do I do? I says, well, have you ever thought of teaching? You're a doctor. So he went and got a college professorship teaching medicine. So he got both his disability income and a teaching salary. Nice way to start life, isn't it? To a degree, anyway. So that's your own occupation. You cannot do any parts of that job. Now, versus what most plans are is any occupation, any, as defined by highlight education, training, or experience. Education, training, or experience, any occupation. Okay? So, if there's a job out there pushing a peanut shell across a gym floor, that's any occupation. There's no job like that, but it's just kind of fun to be exaggerated. Any questions on own occupation or any occupation? Pretty distinctive, aren't they? All right. So a partial disability is where benefits are paid for loss of income once the insured highlight returns to work, but you're still partially disabled following a total disability. That's the definition of partial disability. We call that residual income. Highlight residual. This is where you're unable to perform one or more of your essential duties of your job. Highlight one or more of your job duties. It's not considered a total disability, and we will provide highlight up to 50% of total disability benefits for a limited time. We want to encourage you. So you went back to work, you did well, everything's cool. So you went back to work, and now you're getting 50% of your income, even though you can't do 100% of your job. Residual disability. Now, recurrent disability is bad luck Joe. Write down bad luck Joe. See, if it wasn't for bad luck, Joe wouldn't have any luck. What happened to Joe was he got up, went to work one day, everything was fine, and then some cause caused him to be disabled. So Joe goes home on disability. He gets well, and what does Job do? He comes back and has the same subsequent disability due to the same cause over again. So he went out, got disabled, he came back, and the same cause caused another disability to him. So if it all happened within highlight 6 months, he keeps getting his same benefits package right there. Everything just right where it was. So residual disability, partially disabled, recurrent disability happened twice, bad luck Joe. And finally, the worst of them all, presumptive disability. Loss is presumed to be highlight total, highlight permanent, due to loss of highlight sight, hearing, speech, or 2 limbs. Pretty drastic, isn't it? Presumptive disability. The only thing more drastic is you couldn't work and you don't have disability income. Payments are based on the assumption the insured will not return to work. Highlight that. Never return to work. You can receive lump sum payment or you can receive it in payments. So you have 3 types of disability. You have residual, where you go back to work, but you cannot do all of your jobs. We'll give you up to 50%. You have recurrent disability, Joe, where you go out, you come back, and you go out for the same cause within 6 months. Just keeps your policy going. And finally, presumptive disability, it's presumed, highlight presumed, you're total and permanently out because of your sight, your hearing, your speech, or loss of 2 limbs. Yeah, partial disability. Partial disability is where you're not fully disabled. You're partly disabled. Maybe you have a broken arm. Okay? You're partially disabled. And because you're partially disabled, you're not able to perform all of your job duties, one or more. You understand that part? Okay? So, if you can't do all of your job, but you can do part of it, so it's not a total disability, you can do part of it, the insurance company on the disability, we will pay you 50% of your total disability benefits. So if you can do half your job and we cover you for the other half, your full-time pay during your recovery period, residual disability. Okay? Excellent. Any other questions? Then I got one for you. Already got answers. Excellent. A disability is presumed to result from the same or related cause or a prior disability. Sounds like a, I can't say it. Sounds like a person we studied. How's that? Perfect score. Yippee! Wow, perfect. Disability policies are not that difficult. It's not D, it's not residual. You went out and you came back and you went out again. What do we call that? There you go. It's not C, it's not a presumptive disability. This is a disability where you went out and you got well and came back. Then you got out again because of the same cause of disability. What do we call that? There you go. Beautiful. You guys have got this. It's totally yours. There you go. The recurrent. Recurrent. A is the correct answer. Recurrent disability. Well played, team. The keyword recurrent. Next, we have disability underwriting. How hard is it to write this policy? It's not. Everything is based on the job duties, duties, duties. The duties of your job. What are the duties? Your job description of your duties, your duties, your duties, star, circle, highlight, duties. If that's one thing. If you're a high risk, that's another. It's based on your job duties, duties, duties. We look at your claims history, your stability of the industry. The insurance company has a protection clause called change of occupation. So it protects the insurance company in case the insured changes occupation and doesn't tell us. Changed occupation and didn't tell us. The thing that we worry about in this industry is that if you went from a low risk to a high risk and you're still paying benefits for the low risk, but you're at a high risk job and get hurt there, we will still pay you but you didn't change your benefits. You didn't pay higher premiums to cover you for the higher risk. So we're going to pay your premiums based on uh, pay your claims based on the low risk amount of money we're receiving. And it's going to be substantially less than what you were going to receive if you had told us and paid the difference in premiums with the higher risk. Change of occupation provision. We always asked our customers, have you changed jobs, occupations, or anything, even within the same company? Every once in a while, we'd catch them and save them. So, occupation, 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 your job duties, duties, duties is the single most important rating factor. Star that. Next, do you do insane hobbies like jumping out of planes, parachuting, or bridges with rubber bands tied to your ankles? Hazardous hobbies. What is your age, your gender, your health? How long are we stuck paying you? How much are we stuck paying you? For how long? And what is your elimination period? Your elimination period is your 30, 60, or 90-day elimination period. Okay? So, the longer the time we're stuck paying you, and the shorter the elimination period, the higher the premium. The longer the elimination period, 90, 180 days, and the shorter time we have to pay you your money, the lower the premium. I'm going to go over that with you several more times before we actually get to that, but you'll get it. Okay? Duties, duties, duties. Group disability and business uses of disability income. We have non-occupational, write down off job. Non-occupational, write down off job. Because workman's compensation, remember that? Highlight workman's comp, highlight on job. So if you have a work comp company, which most of them are nowadays, you have a work comp policy, covers you on the job. Non-occupational is the policy you add to that to cover you off the job. Because it's group, we deal with the law of large numbers. It requires participation by a minimum number of employees. Highlight participation by minimum number. Because it's group and the law of large numbers, we do not require individual medical underwriting. Pretty nice. You, the field underwriter, guard against adverse selection and overinsurance. Your job is pretty tight. Now here we have LTD, long-term disability, which I was talking to you about earlier, and short-term disability, STD. So income policies for short-term durations, highlight less than 2 years. Short-term is less than 2 years. How about now? Is that better? How about now? Is it better? Because I do change my voice. Yes? Okay. I just sat back a little bit. I guess I don't get to sit back. All right. Thanks for sharing that. Short-term disability, 2 years. Short-term disability, less than 2 years. That's like Aflac, Colonial, several other companies. They'll cover you for short-term periods. The elimination period is like a sick plan. If benefits range weekly from 50 to 80% of your income. So one of my accounts was Ventura County Fire, Santa Monica Fire, and Van Nuys Air Ops. So we got them short-term disability because that covered them for their extra expenses. They had long-term disability, which covers you for more than 2 years, highlight more than 2 years, up to 65 or lifetime. But it only pays 60% of their benefits. So when you first go out, you're covered, but short-term disability picked up some of the difference to help keep you paced with the other part. Also notice that 60%, if you have mortgage and you get credit life and credit disability, like the example I gave you earlier, that's where it's going to make a big difference on your mental recovery of your physical, of your financial responsibilities. Pretty wild, huh? Next, we have business overhead insurance. Covers the cost of overhead of the business, not the owner's disability. Covers the overhead of your business, not the overhead, not the business owner's disability. So what are aspects of business overhead? Rent, employee payroll, utilities. Write down materials. Materials. Maybe you are you build stuff. and sell the product. So you need materials to put that product together. So it covers the expenses of the office, your rent, employee payroll, utilities, and you wrote down materials. It does not cover the income owners. Now the owner takes the deduction for it, so when he receives the payment, when the owner's out, the owner receives the payment, they get uh, taxed on it. Do I care? No. I'm just telling you in advance because they get taxed. I just take out their Schedule C, for example, and I write it off. Business overhead covers the business, etc. I remember I had one client, I went into the office and he was disabled for like 11 months or 12 months or whatever, it was a long time. I walked in, I looked at the employees and I said, "Hi, I'm Coach Phillip, and don't worry about everything. Please put your resumes away. Just keep doing your jobs really well, and your employer will be back shortly. I will pay the rent. I will pay employee payroll. I will pay your utilities. I will even buy the materials necessary for you to build the stuff you build." Okay? They just kind of, you could actually see the relief on a couple of people. They were thinking, oh my God, will we have a job? Now, key employee, remember that's the woman that brings in 80% of our business. Every single month, she brings in 80% of our business. So this protects protects the company that she works for. So it pays for replacement of her. It pays to train a new employee to replace her. And look at this, loss of revenue. Without her there, we're not going to be making 80%, are we? We might make 30, 40. This covers the loss of revenue when she's out. Death or disability. Highlight all three. Replacement, train, loss of revenue. Business overhead. Here, write down Mr. CPA. Mr. CPA had to sign a contract when he got promoted, remember? So when he got promoted to partner, he had to sign a contract, the buy-sell agreement, that if he died or became disabled, he had to sell his portion of the business back to the business, and the business would buy that portion of the business from Mr. CPA. So it ensures the business partners, enables the partnership, highlight partnership, to buy the disabled partner's share of the business. It can be lump sum, and benefits are tax-free. Usually the company pays for the insurances with after-tax dollars. After-tax dollars are always tax-free. So a business overhead expense policy, a BOE expense policy, as a form of disability insurance, provides payments in all of the following ways, except one. Who doesn't get paid? Perfect. Wow. Okay, you're doing perfect because it's not C. We cover taxes, utilities, and rent. What's the one thing we don't pay? We do pay employee wages. So it's not employee wages, it's not taxes, utilities, and rent. We do pay those. What's the one thing we don't pay for? There you go. Good job. Final answers, please. It's that accept. B is the correct answer. We have a touchdown. All right. Disability income policy riders. Gosh, what could a rider possibly be? Like cost of living. Remember I said the doctor bought cost of living? This is where it raises your income based on the cost of living, inflation. Automatically increases monthly benefits after the onset of the disability by the Consumer Price Index. That actually worked out pretty well for the doctor and several other people, that cost of living rider. Might be 5, 10, 20 years before you need it, but when it does, you need to keep current with inflation. And you all know what inflation is now. The last 3 years have taught it to you vividly, graphically, disproportionately. In disability policies, you can get guaranteed purchase option riders, known as the guaranteed insurability rider. In other words, I can get guaranteed insurance at certain highlight dates, ages, occurrences, Additional insurance may be purchased, highlight, without proof of insurability. It must be based on increase of income at certain attained ages. So down the road, you get pay raises at certain ages, dates, occurrences. Without proof of insurability, we look at your taxes, your paycheck, and we increase your benefit.